Have you ever felt like no matter how hard you work, you just can't get ahead financially? You're not alone. Many of us are held back by common money myths that sound good but actually keep us poor. These are the truths we've been taught by society, our families, and even the media. But what if everything you thought you knew about money was wrong? In this video, we'll uncover the biggest lies about money that trap us in financial stress. From the seductive lure of easy credit to the false comfort of savings accounts, we'll debunk these myths and show you how to break free. It's time to change the way you think about money and start building real wealth. Let's dive in and reveal the truth that can set you on the path to financial freedom. Number 1. The lie of easy credit. Imagine this. You just got a shiny new credit card in the mail. It feels like free money. You start using it for little things, lunches, clothes, gadgets. Soon, the balance grows, but the minimum payment seems manageable, so you keep spending. This is the trap of easy credit. Credit cards can be tempting because they let you buy now and pay later. But what many people don't realize is how quickly interest adds up. The average credit card interest rate is around 20%. Meaning if you don't pay off your balance each month, you end up paying much more for everything you buy. Over time, this can lead to serious debt. Let's look at some numbers. If you have a $1,000 balance and only make the minimum payment each month, it could take you years to pay off, costing you hundreds in interest. Many people end up paying double or even triple the original amount they spent. Credit card companies make it easy to get credit because they make money off your interest payments. They want you to carry a balance. They offer low introductory rates or rewards points to lure you in, but once the promotional period ends, the high interest rates kick in. The key to avoiding the credit card trap is to use them wisely. Only charge what you can pay off each month. If you're already in debt, focus on paying it down as quickly as possible. Remember, credit cards should be a tool for convenience, not a way to live beyond your means. Number 2. The myth of good debt. We've all heard it. Some debt is good debt. People say that borrowing for things like education or buying a home is smart because it's an investment in your future. But is all good debt really good? Take student loans, for example. Many believe that taking on debt to get a degree will automatically lead to a high-paying job. While education is important, student loan debt can quickly become overwhelming. Graduates often find themselves burdened with tens of thousands of dollars in debt, which can take decades to repay. This debt can limit your choices, like buying a house or starting a family. Then there's the myth that buying a home is always a good investment. Yes, owning property can be a way to build wealth, but it also comes with hidden costs. Maintenance, property taxes, and interest on your mortgage can add up. If the housing market declines, you might owe more on your home than it's worth. Plus, tying up all your money in a home can limit your flexibility. Not all debt is bad, but it's important to be cautious. The key is to understand the risks and not just assume that all debt is good. If you take on debt, make sure it's manageable and that you have a plan to pay it off. Look for ways to finance your education without borrowing too much and consider whether renting might be a better option than buying a home. Being smart about debt means thinking critically and planning for the long term. Number 3. The deceptive comfort of savings accounts. Putting your money in a savings account feels safe. You earn a bit of interest, and your money is always there when you need it. But relying solely on savings accounts can be a deceptive comfort that keeps you from growing your wealth. The problem is that savings accounts offer very low interest rates, often around 0.05% to 1% per year. Meanwhile, the average inflation rate is about 2% to 3% annually. This means that the money in your savings account actually loses value over time because the cost of living increases faster than your savings grow. In other words, you're not getting ahead, you're falling behind. Let's look at an example. If you save $1,000 in a savings account with a 1% interest rate after a year, you'll have $1,010. But if inflation is 3%, what you could buy with that $1,010 now costs $1,030. Your money hasn't kept up with rising prices. To truly grow your wealth, you need to invest your money in higher yield options like stocks, bonds, or mutual funds. These investments come with risks, but they also offer the potential for much higher returns. Over the long term, the stock market, for instance, has historically returned about 7% per year after adjusting for inflation. While it's important to have some money in a savings account for emergencies, don't let it be your only strategy. Diversifying your investments can help you keep up with inflation and build real wealth over time. Start by learning about different investment options and gradually shift some of your savings into them. Number 4, the false promise of homeownership. Owning a home is often seen as the ultimate financial goal. People say, renting is just throwing money away, and a house is a great investment. But the truth is, homeownership isn't always the golden ticket to financial success. Buying a home comes with many hidden costs. Besides the mortgage, there are property taxes, maintenance, repairs, and insurance. These expenses can add up quickly. For example, fixing a leaky roof or replacing an old furnace can cost thousands of dollars. Homeowners also need to pay for things like landscaping, pest control, and routine upkeep, which renters often don't have to worry about. The housing market can be unpredictable. While home prices can go up, they can also go down. If you buy a house and the market crashes, you might end up owing more on your mortgage than the house is worth. This is called being underwater on your mortgage, and it can be a financial nightmare. Additionally, owning a home ties up a lot of your money. It can limit your flexibility if you want to move for a new job or other opportunities. Renting, on the other hand, offers more freedom and often fewer unexpected costs. Owning a home can be a good investment, but it's not a guarantee. It's important to carefully consider all the costs and risks. Renting can sometimes be a smarter financial move, especially if it allows you to save and invest your money in other ways. Remember, the goal is to build wealth and financial security, whether you own or rent. Number 5, the illusion of the perfect job. Many people believe that landing the perfect job will solve all their financial problems. They think that a high salary means financial security and wealth. But relying solely on one job, even a great one, can be risky. First, no job is guaranteed to last forever. Companies downsize, industries change, and the economy can take unexpected turns. If you lose your job, your main source of income disappears, leaving you vulnerable. Many people learned this lesson during economic downturns when layoffs were common. Second, even a high-paying job can lead to financial stress if you don't manage your money wisely. It's easy to fall into the trap of lifestyle inflation, where your spending increases as your income grows. A bigger paycheck can lead to buying more expensive things, but this doesn't necessarily mean you're building wealth. You might still end up living paycheck to paycheck, just with fancier stuff. Relying on a single income source also limits your financial growth. Diversifying your income streams can provide more stability and opportunities. This can include side hustles, freelance work, investments, or starting a small business. Having multiple income sources means you're not putting all your eggs in one basket, which can help you stay afloat if one source dries up. The perfect job is an illusion. While it's important to strive for a good career, don't let it be your only financial plan. Focus on managing your money wisely, avoiding lifestyle inflation, and creating additional income streams. This way, you'll build a more secure and prosperous financial future. Number 6, the danger of lifestyle inflation. Lifestyle inflation happens when your spending increases as your income grows. It's easy to fall into this trap. You get a raise or a better job, and suddenly, you're buying nicer clothes, eating out more often, or upgrading your car. While it feels good in the moment, this habit can keep you from building real wealth. Let's say you get a $5,000 raise. Instead of saving or investing that money, you start spending more. You might move to a bigger apartment, take more expensive vacations, or buy the latest gadgets. Soon, your higher income is matched by higher expenses, leaving you with little or no extra savings. This cycle can prevent you from achieving long-term financial goals like buying a home, saving for retirement, or starting a business. If you always increase your spending when your income rises, you'll never have enough to create financial security. The key to avoiding lifestyle inflation is to live below your means, no matter how much you earn. Save or invest a portion of any income increase. Create a budget and stick to it. By controlling your spending, you can ensure that your financial future is bright and secure, instead of just keeping up with your current lifestyle. Remember, building wealth is about making informed, strategic decisions and planning for the long term. Take control of your financial future today. Now, if you want to learn how to achieve financial success, then watch this video next. And if you made it to this point of the video, please like and subscribe to the channel to see more content like this. Thanks for watching, and I'll see you in the next video.